Let's say for the sake of argument that you have not built out your 2026 forecast yet. It is December of 25. So let's think about how that works. The first thing you need is to forecast your revenue. So everything's kind of dependent on that. When it comes to retail, you want to be thinking of a realistic velocity, units per store per week, how many stores you're going to be in, and what's realistic in terms of number of cases that you're going to sell, your case price to those accounts, and when do you think the timing, will occur. Then on the D2C side, you want to be thinking about what sort of established recurring revenue do you have? Is there any seasonality to it? What about new customers? How are you going to be acquiring them? How many? If it's through like direct ads, how much has your CAC been in the past? And how much can you expect to pay for those customers? And then, multiplying all that by like your average order value and taking into account discounts and returns and all those things. In contra, on the retail side, the contra is trade spend. So both compliance and promotional trade spend, compliance slash, DC opening fees and whatnot. And then, that gets you to net revenue. Then obviously you'll have COGS. So number of cases times case price for your COGS, which includes everything it takes to get that inventory ready for sale. So freight in to the co-packer, the raw materials, the processing, the freight to the fulfillment center, all that good stuff is included in your COGS. So what do you think that's going to be? That's obviously based on the revenue. In terms of your, below the line, first you want to think about selling and fulfillment. So do you have a broker on the retail side? Do you have any freight on the retail side? Retail, food service, whatnot. D2C, obviously have to ship it. And are there, Shopify fees and Amazon fees that are going to be layered on there? So all the selling and fulfillment kind of together. Then after that, we like to look at the cost of customer acquisition. So usually not a ton of that in retail. You might have some like co-op ads. And then on the D2C side, that's usually the bulk of your, obviously customer acquisition cost in D2C. So what is that going to cost based on the revenue that you have predicted? But then obviously you do have some marketing that is not specific to a channel. And after that, it's just your overhead, right? So what are your sort of fixed costs? Do you have rent? Do you have employees that are not specific to like fulfillment or whatnot or production? Looking at all those costs and then coming up with a bottom line. And that gives you your P&L. But then after you get the P&L, the bottom line is not your burn rate, right? Just because you break even from a profit and loss standpoint doesn't mean that you will end up breaking even from a cash standpoint, because especially if you're growing, AR is going up. AR is the use of cash. Inventory is going up. Inventory is the use of cash. AP might be going up. That's actually a source of cash. So anytime you put something on account, you recognize the expense, but you don't pay it yet, that is going to be a source of cash in your statement of cash flows when you're kind of reconciling between your net income and how much cash are you actually going to need and are you actually going to have in the bank. So kind of making those adjustments to look at the next 12 to 18 months, how much cash am I going to need? Do I need to raise money? Do I have enough money? That is how I would recommend going about your 2026 planning if you haven't already. Let us know if you have any questions about that. We do strategy calls, one-off. We do projects where we build financial models. And then we also do retainers where we handle this type of stuff every month. Feel free to reach out with any questions and let us know if you think we can help.